Hello, this is Shinichiro Kasai, licensed real estate agent in Japan. So today I would like to talk about, based on the statistics released by the Ministry of Land and Construction in Japan, about the number of the construction in March 2026. So let's get started. We are here to look at the Japan real estate market, but I must warn you, the old rules no longer apply. Based on the construction start statistics from March 2026, we are witnessing a massive structure change. We call it the Great Realignment. Today, I am not just going to show you data. I will explain exactly why development is moving away from city centers to suburbs, why traditional sectors are losing money to niche sectors, and why you must focus on micro demand to survive. So let's look at the reality of what is happening on the ground. Please look at this slide. This is a big picture of how the real estate map is being rewired right now. We have a chain reaction happening in 3 steps. First, we have a huge macro headwind. Nationwide construction starts have crashed by 29.3%. Why? Because rising construction costs are choking the supply side. Second, because traditional building is no longer profitable, we see structural shifts. Capital is literally running away from offices and retail and running toward accommodation and medical facilities. Finally, this creates our target, micro opportunities. Since developers cannot make money in prestige hubs anymore, investment is spilling over into suburbs and chasing hyper-localization corporate demand. Let's look at the exact numbers. In March 2026, total new housing starts were only 63,495 units. You can see this sharp, painful drop on the chart, down 29.3%. And this is happening everywhere. Owned houses, rented houses, built for sale houses, they are all down by 20 to 30% uniformly. But please do not misunderstand this data. This is not a collapse of barrier demand. People still want to buy houses. The real problem is on the supply side. Surging construction materials and labor costs have created a massive profitability barrier. Developers simply cannot build and sell at a profit anymore, so traditional development is effectively frozen. If residential is frozen, what about non-residential? This chart shows a very clear story. Total non-residential development dropped by 23.7%. Look at the blue bars on the left. Retail stores crashed by 28.6%. Offices dropped by 24.3%. Even warehouses went down by 10.1%. Now look at the right side. Why are accommodation uses up by 60.9%? Why are medical and welfare uses up by 7.9%? The answer is simple. Demographics and tourism. Capital is abandoning assets that rely on general corporate performance because the economy is uncertain. Instead, smart money is pivoting sharply toward undeniable, solid demand bases. The booming inbound tourism market and Japan's rapid aging population. So what happens when profit margins are crushed in the center? We see a Tokyo exodus. Look at this map. The total Tokyo metro area saw a 19.1% drop in housing starts.
But the core of the problem is central Tokyo. Condominium starts there plummeted by a shocking 60.1.7%. Only 1,606 units were started. Land prices are too high, construction costs are too high, and developers simply cannot pass those costs to the buyers. So the money had to go somewhere else. It flowed outward. Look at Kanagawa Prefecture. Sorry, this map shows that Kanagawa is not this place. This place is Chiba Prefecture. Kanagawa is below. An explosive 519.85% increase. Saitama is also up by 10.4%. Developers are shifting to these commuter areas because here they can still build at price points that actual working class buyers can afford to pay. Now let's talk about these regions. Many investors think if Tokyo is too expensive, let's invest in regional hub cities with famous universities. This slide proves that past prestige does not guarantee future viability. Look at these numbers for historically strong cities. Kyoto down 17.4%, Fukuoka down 59.9%, Hokkaido down 58.6%, Aichi down 40.3%. Why is this happening? Because even in famous regional hub, if the local economy cannot absorb the higher sales price or higher rents needed to cover the new construction costs, the project dies. Developers are immediately postponing construction in these cities. However, regional picture is not completely dark. Selective development is happening, and some tier 1.5 cities are showing resilience. Look at Osaka Prefecture. Yes, it is down, but condominium drops were limited to 24.0%, significantly outperforming the national average. More importantly, look at Miyagi Prefecture. Built-for-sale housing actually surged by 40.6%. How is this possible in a high-cost environment? It comes down to two specific survival conditions. First, a highly stable employment base. Second, immediate urban redevelopment opportunities. Miyagi has both right now. If a city does not have these, the money will not come. We also need to look at micro-geography, specifically the commuter spillover. When central cities become impossible to develop, the surrounding areas boom. In the Kansai area, development hurdles in central Osaka pushes mega developments into Nara Prefecture. Built-for-sale housing there skyrocketed by 495.6%, driven mostly by 584 new condo units. In the Kanto area, the pressure from Tokyo pushed development into Ibaraki Prefecture. They saw a 20.4% increase, and 100% of that was detached houses. What does this mean? It means developers are migrating to outer commuting zones to offer price-advantaged projects to families who are priced out of the center. This slide is perhaps the most interesting part of the data. We call it extreme localized demand. Look at these isolated spikes. Ehime Prefecture up by an unbelievable 2,150.0%. Why? Because of targeted company housing for employees. Shimane Prefecture up 321.6%, driven entirely by rented housing spikes. Kumamoto Prefecture up 44.1% due to built-for-sale capital inflows. What is the takeaway here? Regional markets are not declining uniformly. Capital is highly intelligent. It flows instantly to pinpoint locations where specific corporate capital expenditure, Capex, create unavoidable actual demand. If a big company builds a factory, the workers need housing. That is macro demand. To summarize everything we have seen, we must fundamentally realign our target investment profile. Look at this comparison. Traditionally, investors look at central hubs and imperial cities. Now we must look at commuter spillovers and specific regional nodes. Traditionally, the sector drivers were general corporate performance. Now the drivers are inbound tourism and demographic realities. In the past, the success factor was the prestige of the location. Today, the only success factor that matters is the ability to pass through costs. The baseline for investment has completely shifted from historical status to pragmatic mathematical cost absorption. I want to leave you with this final framework. The 2026 real estate equation. On the horizontal axis, you have localized actual demand. On the vertical axis, you have the capability to absorb costs and pass through prices. If you are low on both, you are in the stagnation zone. If you have demand but no pricing power, it is a value trap. Our only goal is to operate in the top right red box. The 2026 Viability Zone. In a market defined by restricted supply and surging costs, project success relies entirely on these two intersection factors. You must pinpoint unavoidable macro demand, and you must ensure that location can absorb the price thoughts. The message is simple. Find the macro demand. Ignore the macro noises. Thank you very much for seeing and see you soon.